All right, well, this is how money makes money. Investing compared to a casino because there is risk involved, and also people like to gamble on different types of investments. But just like you can count cards in a casino and win every time, you can study and get really well versed in the stock market, and you can make money even though there's risk, just like in a casino. There is luck involved, but if you do enough research and work hard enough, you get what you pay for. So there's value investing. Security analysis written by Benjamin Graham and David Dodds was written in the 30s, and it's still very important to this day. This was when the market crashed in the Great Recession, and they were still, making really good money. But their approach to the stock market was to choose companies that on paper were more valuable than what they were being traded for in the market. If it's undervalued and it's a strong company with good leadership, they will eventually become more valuable and traded at a higher value. Why not buy something that's literally valued for more than what it is being sold for? This is the value investing approach. So the biggest indicator when looking for a value company in that way would be the price to book ratio, which I'll go over in a second. But it's pretty much, or honestly, I can just show you on the next slide. Price to book ratio is calculated by dividing the company's stock price by the book value per share. So if it's less than 1, that means their assets combined are worth more than what the company is valued for on the stock market. So if the company even went bankrupt and the price to book ratio is less than 1, then you would get all your money back, and you would then get some more because you're paying for something that's worth more than what you're buying it at. It's literally buying money for however long or for however many companies you can find to do it. But price to book ratio is very important for value investing. Earnings per share, very important. This measures the company's profit on a per share basis. The higher the better. The more money you're making per share, the more money you're making per share. It's pretty self-explanatory. The price to earnings ratio is the price of the stock over the earnings per share. So you would like that to be as low as possible. So if you own $1 in the stock in the company, they're making $1 for every dollar that you are investing. Dividends is the main reason to get into the stock market most of the time. Companies will give, well, not all companies, but most companies will distribute some of the company's earnings to the shareholders. So if you own part of the company and they're making good money, a lot of profits, high earnings per share, low PE, they will be literally giving you payouts if you own shares in the company. Speculative investing is a little bit different than value investing. People who look for more speculative companies look for future growth. So you know how Tesla grew exponentially over the past few months. That's all speculation. They think that the future will be electric cars, which honestly might be right. And there are other ways to speculate invest, not just news, not just on what type of product they're selling, but earnings per share growth. Let's say they're not making much money now, but you can see that their revenue is growing strongly, their sales are growing strongly, then you might want to invest in that company. Running out of time. There are a lot more indicators that I'm not covering because there are so many ways to look into the stock market. There's reading charts. I have a few charts to show as well, but these are some of the companies that follow all of the recommendations that I laid out. Price to book, low. Price over earnings, low. Earnings growth this year, high. Earnings growth or EPS growth this year, high. EPS growth quarter over quarter, high. Sales growth quarter over quarter, high. And I expect most of these companies will be doing better after Corona has stopped affecting the market. This is one of the examples of success. In March, they crashed. You can see it right, let me see if I can use it here. But they had strong earnings, strong sales, everything that I listed, they were doing very well in. And they shot up and made 300, or the stock price went up 300%. Like a lot of companies that are on lists like that will do well in the future. And that is my works cited. Thank you.